For many of you, this drawdown in markets is a new experience. Did you know this sell-off actually started in February 2021 for many sectors, but has accelerated in 2022 because of real rising inflation, rising interest rates, the war in the Ukraine, and continued global supply chain constraints, such as with microchip manufacturers? If you haven't been an investor through a prolonged market crash, you're probably wondering why the market hasn't bounced back yet, like it did shortly after March 2020 and during the pandemic reaction crash. Unfortunately, stocks and crypto are highly unlikely to recover quickly because this crash is related to core economic fundamentals and market dynamics that are unlikely to change quickly. Could the worst of the crash be priced in already? Maybe, because the downward motion has accelerated and because I believe the global economy is already in recession. Will we see some interim bounce in the market? Possibly. It's never really going to go straight down. But if inflation keeps going up, we're likely to see more market weakness because central banks are likely to keep raising interest rates. Panicking and selling investments in your portfolio is the worst thing to do. Fear of further financial loss drives emotional reactions that lead to poor investment decisions. Fortunately, there are a number of things you can do with your portfolio to reduce the pain. So let's take a look. Hi, I'm Lachlan Campbell, the founder of Mad Success. One thing I've discovered over my 30-year career in finance is that a key to a happier, wealthier, more fulfilled life with a lot less stress and anxiety is better money management. And that includes how you plan and invest. The purpose of Mad Success is to empower you to design a life that you want to be living in alignment with your values and dreams, and without the constant worry of not having enough money. How do we do that? By providing resources and coaching to help you design an exciting vision and plan for your life, and to grow your confidence and knowledge with money and investing to ensure you fulfill your life plan. Getting clear about your dreams and goals and creating a plan or map how to achieve them should be a central focus in your life every day to be truly fulfilled. But too often money, or the lack of it, becomes the central focus of our lives, leading to financial stress, worry, and furthering a mindset of money scarcity. With a scarcity mindset, there's never enough, and not just money. A scarcity mindset points to anything that's lacking in your life, and it's usually around self-judgment. I'm not smart enough, good looking enough, talented enough, fast enough, tall enough, connected enough, and so on. This money mindset undermines your ability to achieve your most important dreams and goals. Am I right? Money's just a tool. It's really important to remember that. The purpose of money is to underpin and support your ability to live a fulfilled life and achieve your dreams. Better money management means developing healthy money habits, growing a positive relationship with money, and learning how to invest confidently without reacting to market turmoil with emotions, panic, and fear, which happens consistently with new investors and with investors who do not have a focused long-term financial life plan, which includes an investment plan. When you're starting out as an investor and looking to build your wealth for the long term and to achieve your life goals, investing regularly and consistently in every market condition should be the primary way you invest your money. So it's really important to have a clear idea of your money needs. When you have a clear vision of your life and you have set clear goals, you know when you require different pots of money for different times in your life. Money is meant to support living your life. With a clear vision and plan for your life, money becomes secondary. It's the tool that will enable you to achieve your goals. Getting married, traveling the world, starting a business, buying a car, a new computer, buying a house, and so on. These goals all require money. But with a clear plan, your money does not run your life. You do. That's a big difference. With a financial life plan, you're not panicking about the markets as they fall because your money is correctly invested based on your money timing needs. We all have different money needs. If you don't have clearly designed goals, then it's very likely you'll panic during a market crash because money you have invested has no purpose or time frame for investment. Your instinct and reaction will very likely be to sell your investments to stop losing money. This makes perfect sense if you don't have a plan for your money, other than having more of it. I mention having a plan for your life and subsequently for your money in all of my videos because it's fundamentally important to living a less stressful, happier, wealthier, more fulfilled life. Having a life plan is key to better money management, and it's especially important managing times of market stress and perceived investment loss. What do I mean by perceived investment loss? You only realize an investment loss if you sell the asset at a price lower than when you originally purchased it. Likewise, when you buy a stock or a crypto or bond or a home, if the price of the asset goes up, you have a gain. But it's only what we call a paper gain until you actually sell the asset. For example, let's say you bought a stock and invested $100, and in 1 year it rose to $120, a gain of $20 or 20%. But you didn't sell it. Because you didn't sell it, you have what's called a paper gain, because you haven't realized the gain as cash. You still own the stock. So let's say over the next few months, your stock investment falls to $80 in value. Now your investment is actually in a loss, but because you have not sold the investment, it's just a paper loss. Yes, your investment is down, but if you don't sell, your investment has the possibility of rising again over time. The challenge for most people is because the stock rose to $120, that's the headline number that sticks in their mind, and they see the loss. That's the difference between 120 down to 80, a $40 decline, when in reality, the current market condition is just a paper loss of only $20 because the original investment was purchased for $100. So by not selling, you've not yet gained in the case of $120 or lost any money in the case of a market price of $80 because you still own the investment. It still just cost you $100. If you bought a solid company with real profits and a solid track record or a quality investment fund, and it was not just some speculative asset that your sisters, boyfriends, friends, best friends, buddy told them about, and it was indeed a solid investment, then over time, if you hold on to this quality investment for the long term and not panic during a sell down, your investment will eventually rise in value again as you originally intended. A further point to consider, and this is critical, if you believed in the investment at $100 and it falls to $80, why would you sell at these levels? Why not buy more and lower your average cost? Because now the asset is 20% less expensive. If the original investment idea was a quality decision, then what has fundamentally changed with the investment at a 20% lower price? Lots of great companies right now are being sold down technically because of hedge funds and sophisticated investor algorithms that are forcing the price lower. Just because the market is volatile, if your investment idea remains the same, there should be no need to panic and sell it if you bought a good investment in the first place. I hope this makes sense. Now, if you bought an investment at $100 and you have no idea whether it was a good investment or not, such as with many cryptocurrencies or high risk, no profit, but very hyped stocks, then yes, you may want to cut your losses and get out of the investment. Learn from these mistakes and don't speculate on investments you know nothing about in the future. If you are speculating, as I've said in so many videos, then speculate with money you're willing to lose because markets do crash as you're now experiencing. If you have a clear financial life plan with long-term investment objectives, excellent. You wouldn't panic in these markets. You might worry. I get that. It's natural. But with a plan, your money will very likely be thoroughly and thoughtfully managed, saved, and invested according to the plan and your money needs. So what's a money need? Quite simply, it's knowing when you need your money. It's the timing of when you'll need your money to meet your goals. For example, having savings set aside uninvested for an immediate need, such as your emergency fund. Part of having a financial life plan is determining each of your money needs, what are referred to often as savings buckets. Are your money needs more short-term, such as 3 to 18 months, to pay off taxes, a maturing debt, or perhaps for school tuition? Maybe you have money needs for the medium term, such as in 2 to 4 years, for the deposit on a home, a tropical wedding, or to buy a boat without taking on debt. Or you're saving and investing a pool of money for the long term, such as 5, 10, or even 20 to 30 years in the future, such as for retirement. When you need your money will drive how you should be saving and investing it. With such a plan for your money, you won't be stressed by sharp market corrections. During a market correction, panicking is the worst thing to do. Reacting to the stress and fear of potential financial loss drives emotional reactions that lead to poor investment decisions. Fortunately, there are things you can do with your portfolio to reduce the pain. Here are some ways to protect your portfolio from a market crash. The first, always keep your emergency fund money safe and immediately available. This means it should never be invested in the stock market, so it's never at risk of falling in value. And despite what many young influencers have argued, that inflation is so high your money must be invested, well, what do you think their emergency funds look like now in the face of the market crash? If you're worried that inflation will erode your emergency fund's purchasing power, which it does over time, then top it up each year by the rate of inflation to ensure it's kept current. Short-term savings, money needed in the next 3 to 18 months or so, should be invested, but only in financial instruments that have low or no price volatility. Are short-dated fixed income investments and can be easily converted into cash. Examples will include financial instruments such as certificates of deposits or short-dated government notes that you can hold to maturity and earn some interest income to offset inflation. Any interest income received on these investments can be reinvested into other financial assets so that you can compound your returns over time. But I urge you not to invest short-term savings into the stock market or into high-yielding corporate bonds or bond funds. Why? Because the stock market can crash, and because now is not the time to be investing in bonds. Bonds have completed a 40-year bull market since the 1980s, where the interest rates on bonds in North America fell from well above 10% to nearly 0% interest of late. The price of a bond falls as interest rates rise. Bond prices are now in decline and will continue to fall for as long as interest rates continue to rise, which they likely will for the foreseeable future as central banks are focused on fighting inflation. Now, that said, if the US, for example, goes into a recession later this year or next, which it likely will, the US central bank, known as the Federal Reserve Bank, or Fed, may slow its interest rate hikes so as not to push the economy deeper into recession. As well, recessions are very good at slowing inflation and help the central bank do their job to slow it. Because in a recession, people buy less goods and services. So demand falls, and therefore suppliers will stop raising prices, or they may even lower their prices to try and remain competitive and attract consumers to buy their goods and services. Medium-term money, which you need over 2 to 4 years, can be invested in more risky assets such as stocks, but consideration should be given to less volatile industries such as banks and utility companies and the like, that tend to rise less in a rising market, but fall less in a falling market. This way you have less exposure to volatile price swings over this shorter time frame. And don't put your money at as much risk and exposure as long-term money while still putting your money to work for you. For your long-term money, you have more options in the midst of this market sell-off. First, you could choose to sell everything in a panic and hope you can time the bottom of the market crash and buy it all back. Many inexperienced investors try to do this, as well as those without a plan. These investors tend to buy high and sell low based on emotions rather than a plan. They sell when the market crashes, taking losses, but then are too afraid to buy back in as the market continues to fall because social media and news channels they watch are screaming doom and gloom. So they're too afraid to re-enter the market, and they miss out on bigger returns and large outside gains as the market recovers. That's how to stay broke, but it is an option. The second option for your long-term investments is to take profits on your investments as the market rises and be sure to get out of the profit as it starts to fall, but keep the original investment amount invested. Taking profit, even if it's now a lot less than you had, raises cash so that you can buy back into the market once the market has stabilized, perhaps buying more of the same assets, but at a lower price. But keep the original capital invested if you know you invested in good assets before the crash. Note, selling and capturing profits depending where you live, could generate capital gains tax. So keep that in mind. If you have a regular monthly investment plan, keep investing each month so you keep dollar cost averaging and compounding your returns. Don't be afraid and stop your monthly investings. You're buying at less expensive levels, so keep investing. Option 3, stay fully invested. Keep investing with your monthly income as part of your monthly investment plan and look to cut costs sharply in your life temporarily so you can invest even more because stocks are on sale. Buy a diversified selection of key stock indices such as the S&P 500, a world stock index, perhaps an emerging market index, or a small cap index like the Russell 2000. This creates a diversified portfolio of stocks because you don't know which will recover first. If you're buying single stocks, buy the best companies in each sector that you're interested in. Here are some bonus tips. Let me tell you what ultra wealthy friends of mine do with their money during times of market downside stress. The ultra wealthy that I know, people with hundreds of millions or even billions of dollars, maintain core investment portfolios that they might look at and rebalance once or twice a year. But they also know that when a stock market is a bull market, for as long as this one has, they captured and removed profits from their portfolio over the last few years. They stay invested with their core portfolio for the long term, just as I advise you to do in all of my videos, but they also take profits, capture those returns, and then sit on cash with that money, patiently waiting for the market to fall. By the way, back in early February, I produced an entire video dedicated to these billionaire investment tips. Click on the link above if you want to learn more, or click the link later in the description below. They are sophisticated investors and they are not excessively greedy. So they've been selling and taking profits out in the rising market. They've been sitting on a lot of cash, waiting for this market correction, which they knew would eventually come. And now they're starting to buy back into the market bit by bit with each day's sell-off. They don't try to time the bottom of the market. They know that's impossible, but they will have done their homework and calculated what they believe to be a worst case scenario market sell-off. They buy into the best companies across the different industries that they follow as the stock prices fall and approach their downside projections. They've predetermined which stocks to buy and what price makes the stock very attractive to buy again. How did they know to sell early? Because they're disciplined investors and they have a few key objectives. Profit, yes, but also to ensure they don't lose capital. They don't try to guess the top of the market. So when an investment rises and meets their target level of price and profit, they sell. And then after they buy back in, it gets pretty boring because they wait. This is how they became billionaires, with patience. They wait usually 3 to 7 years in order for the market to bounce back stronger than before. So they double or triple their money, or in some cases profit significantly more. They then sell and take profit and leave their core portfolio invested. And they follow this pattern consistently over time. Buy the best companies in each industry sector that you want to invest in, and then don't sell them. Let them grow and profit your future. Buy for the long term and continue to buy month after month over time. If you've got value from this video, please hit the like button, subscribe to the channel, and please share the Mad Success channel with your friends, family, and colleagues who could benefit from it. If you'd like to discuss these or any other topics with me further, send me an email, ask@madsuccess.com, or ask your questions in the comments below. I'm Lachlan Campbell, and this is Mad Success. Cheers.